All right. Well, good morning, everyone. Happy Monday. Hope everyone had a great weekend. And thanks for taking a little bit of time out of your day to join us today. I'm Todd Beckmann, co-founder of Well-Traveled Wealth. And if you've turned on the news lately or opened your phone for more than about 5 minutes, you've probably seen no shortage of headlines about markets, inflation, interest rates, politics, and just about everything else. Some days the headlines make it sound like the sky is falling, and other days everything is supposedly perfect. So our goal today is really to help tune out some of that noise and focus on what actually matters. We'll take a look back at the second quarter, discuss what's been happening in the markets and the economy, hopefully leave you feeling a little bit more informed, a little bit less overwhelmed than when you logged on. But before we jump into it, just a couple quick housekeeping items. The first one is that today's webinar is being recorded. So if you'd like to revisit the discussion, or if you know someone that wasn't able to attend, we'll make sure to send the recording out when the webinar concludes. Second, we'd like to make this as interactive as we can. So if a question comes to mind at any point during the presentation, please use the Q&A button at the bottom of your Zoom window to submit it. Don't worry about saving your questions till the end. You can just type them in as they come to you. And then I'll be collecting them throughout the presentation. And once Kara wraps up, we'll spend the remaining time answering as many of them as we can. And now, I guess, the fun part, but it's my pleasure to introduce today's guest speaker. Joining us today is Kara Murphy. She's President and Chief Investment Officer at Kestra Investment Management. She leads Kestra's investment team, providing market research, portfolio guidance, and investment strategy to financial advisors and their clients across the country. Over the course of her career, she's held chief investment officer roles at firms including Goldman Sachs Personal Financial Management, United Capital, and AIG funds, bringing decades of experience helping advisors and investors navigate changing market environments. Many of you may have also seen Kara on or in places like CNBC, Bloomberg, Yahoo Finance, or quoted in publications like the Wall Street Journal and Barron's, where she regularly provides insight on the markets and the economy. Personally had the privilege of hearing Kara speak a number of times over the years, and one of the things that I appreciate the most is her ability to take complex market and economic topics and explain them in a way that's practical, relatable, and easy to understand. I know that you're all going to get a lot out of today's discussion, and Kara, thank you for taking the time to be here with us today. We're all looking forward to hearing your perspective. And with that, I'll go ahead and turn it over to you and let you get things started.
Well, thank you, Todd. It's really a pleasure to be here. And thank you, everybody, for joining us today. I think I heard you say you hope that folks come away more informed and less overwhelmed. And I think those are great goals. It is way too easy, as you suggested, to kind of like, I have Bloomberg TV on right now or CNBC, like whatever your sort of like news outlet of choice is. It's very easy to be overwhelmed. Partly because that's what media's job is, right? They're there
Yeah.
to kind of like grab headlines and to get you out of your seat. So we'll take some time to kind of go through what's happened in the market recently, talk about where we are in the economy, and then also identify some areas where we think there are opportunities in the market and some places to kind of dig deeper. Todd, as you suggested, like I always love it when people ask questions. It's super helpful for me to understand kind of what's top of mind, what things might be confusing or worrying. So please do take advantage of that Q&A button that Todd suggested, and we'll leave time at the end for questions. And if I see anything coming up as we go, I'll try and weave those into some of the presentation as well. Um, I will first start with kind of an overview of what has happened recently in the market. So we're a little bit past the halfway point of the year. And I feel like, summer is often a time to kind of take a deep breath. A lot has happened in this first half of the year. And when we break down, look kind of like over that course of 6 months, what we see are that asset classes have done quite well. And it's sort of remarkable given, again, what Todd suggested. If you've been reading the headlines, you might not guess that markets have actually done quite well. So all the way on the left, you'll see US. So here we're using the S&P 500. So this is the most common measure of the US stock market, really focused on large cap stocks, up 10% for the first half of the year. That's actually a really, really strong return. On average, over time, stocks tend to return about like 8, 9%, depending on the time period that you're looking at. So here we're essentially capturing a full year's worth of return in just 6 months. But what's particularly interesting is if you look at emerging markets, up 24% in just a handful of months. That's really, truly extraordinary returns. And then, of course, developed ex-US. So think, that's mostly Europe and Japan, also with very strong returns. Now, remember, this is a period of time when we have broadening conflict in the Middle East, we have soaring oil prices, we have continued tariffs being thrown out. So there's still a lot of noise in the market, but these stocks have tended to go up. And we'll talk about why. Those dark bars in the middle are fixed income. So the US aggregate is the broadest measure of the bond market that we have for the US. You can see mildly positive territory. Other areas like high yield, investment grade corporate bonds, and municipal bonds also like solidly positive territory. Not gangbusters, but still positive. And then I'll attract your attention to the commodities on the right. So this is, it's a collection of very diversified things. So oil is a big part of it, but you also have precious metals, things like gold and silver, and then agricultural commodities. So there are a lot of things that go into there. On balance, you can see really strong returns. So a good portion of that has come from oil in the first half of the year. The gold has been a big detractor, but then some agricultural commodities have also contributed to that. And there are kind of like benefits and drawbacks of having high commodity prices, which we'll talk about. If we dig in a little bit further into US markets, you can see from sector returns, again, almost all sectors were positive for that first half of the year. I will note information technology towards the left there, up 20%. And then if you look at communication services, just barely positive. Those are the two sectors where you tend to see the Mag 7 really concentrated. And what's interesting is that they're quite different. Those two sectors for the previous 3 years had looked very similar. And we'll dig into this a little bit more in a few minutes, but technology, think things like semiconductors, which have been on a tear so far this year. This is what I would call like the second wave of the AI trade coming in, right? So some of the Mag 7 have not been leading, but we've seen some semiconductors. These are the companies that build the chips that run the computers that we all use every day. Industrials, I think, have also benefited from this. These are the companies that are building the data centers, putting in the power, building the servers. So you see very much kind of like the second leg of this AI trade in the first half of the year results. I will also highlight energy. Okay, so we looked earlier, commodities were very, very strong. Strong oil was a big part of that. Strong oil prices drive the stocks and the earnings of energy companies, and you see that really happening here with those names up 20%. So taking a look briefly on the fixed income side, so let me just spend a moment on this. This is what we call the Treasury yield curve. It's sort of like a bit of a strange concept, but I think it's worth spending a moment to sort of understand because this has been a really important driver of what's been happening in the markets. So that dark line at the bottom is the Treasury yield curve as of the end of last year. And what you see all the way on left is what's the interest rate when the government is issuing a bill or a bond. So what's the rate for 1 month? And then all the way on the right is what's the rate for 30 years. So think about this. If you're lending money to somebody for 30 years, you're going to want more for that because it's a really long time period. If you're only lending it for like a month, you might accept less. That's that shape of the yield curve that we talk about. So 30-year yields tend to be higher than 1 month yields. That's actually not always the case, but in general, that's what we would call a normal curve. And you can see that dip in the middle, right around 2 year. That's because the Fed was expected to cut interest rates into this year. Now, look at that light blue line. What you see is overall all rates going up. So this is, it's been in the headlines a lot lately. Interest rates have gone up, but in particular on that 2 year piece, that 2 year rate has risen the most because the market has changed what it thinks the Fed will do. And we'll talk about this a little bit more, but at the beginning of the year, the market thought that the Fed was going to cut rates 2 times. Now the market thinks that the Fed might raise rates 1 time. And you can see the impact of that in this yield curve right here, which is why I think it's worth spending a moment on it. But if we think about that, like what's the implications then? What's the implication for the broader economy? So let's take a look at that. I grew up in this business with this mantra of don't fight the Fed, right? The Federal Reserve decides when interest rates go up, when they go down. They have other tools in their toolbox as well, but that tends to be the most powerful one. And if the Fed is lowering interest rates, it's the equivalent of stepping on the accelerator, right? That will filter through the economy and help economic growth. If the Fed is increasing interest rates, it acts as a brake, right? It'll slow things down. So this is a dashboard looking at the kind of like five main areas of the economy that we follow. Monetary policy is up at top because of that mantra of mine that I grew up in the business with. Don't fight the Fed. What the Fed is doing has a huge impact on the direction of the economy. And this is one of the areas that we changed recently. At the beginning of the year, we had been tilting towards the green, again, because the expectation was the Fed was going to cut interest rates, which are stimulative for the economy. But now we've swung closer to the red. Now we think the Fed might raise interest rates, and at the very least, they're acting more as a brake on the economy. And we'll talk a little bit about why that is, because there's a lot of complexity in there. Manufacturing, you can see that's another one that recently went more into the green. Consumer has been, we'll talk about this because it's complicated, because it's hard to say that consumer is this. The consumer is a lot of different things. There are some consumers who are strong, some who are weaker, but in general, that's moved a little bit closer to the red. Housing has been in or close to the red for quite some time, largely because of high interest rates. And then labor is quite remarkably neutral, right? This is another area where there are a ton of headlines that are sort of talking about this massive job loss because of AI. But interestingly, when we look at the numbers, they actually look quite stable. So let's dig into these a little bit more. Inflation is one, if you've filled your gas tank or if you've gone grocery shopping lately, you have felt the impact of inflation. Prices have been rising at a uncomfortable pace, let's call it. So this here is looking at core CPI, so core consumer price index. What the Fed does is they look out and they gather prices for tons and tons of different things that consumers tend to buy. Then they'll take out things that move around a lot, namely food prices and energy prices. As I mentioned, if you fill your car or you go grocery shopping, you feel those prices, right? So the reason why they take out food and energy is not because they're not important, right? They are a big drag potentially on consumers' pocketbooks, but because they tend to move around a lot. So they add a lot of noise. So we've taken that out just to kind of smooth this a little bit. And we have a couple different lines here. So this is showing the growth of consumer prices going all the way back to the 1950s. I find it really helpful to have like a broader historical context, because often, again, because of the headlines, we're really focused on a very narrow period. So let me draw your attention to the right of that chart. You can see that big spike up during COVID. I know we all lived through that. That was really painful. Eggs prices were soaring. It seemed like everything was soaring. We have seen consumer prices come down significantly. Well, I should say consumer price increases have slowed significantly during that time period. That gold bar there is the average rate of increases over the last 30 years. So we're right back to average of the last 30 years. But the Fed says they want inflation even lower. So that's that blue line. We're at 2.6 today. The Fed really wants it at 2%. So as I said before, the pace of increase in prices is an uncomfortable rate for the Fed. What that means is that they can't cut rates the way that the market may have expected earlier this year. And remember, we're not even showing the impact of oil here. As we all know, oil has gone up quite a lot. So we know that there's this potential pressure outside of these numbers that's sort of like keeping these price increases up, because those higher oil prices eventually filter through to other prices. So what that means is that the Fed has a lot less room to cut interest rates relative to what we thought earlier in the year. The other side of that coin is kind of like the overall growth in the economy. And there, the picture is much more rosy. So this is I hate to say it, but I think this might be my favorite economic indicator. I love all my economic indicators, but this is one. The reasons why I like it so much are, first of all, it goes back to the 1970s, at least the manufacturing one does. So we have a really long time period to be able to look at. This also comes out monthly, so it's very frequent, and it comes out very quickly after the end of the month. So what happens is that you have the folks who are collecting this data will call up managers at different types of companies and say, hey, do you have more new orders or fewer relative to last month? Are you hiring more or less? Are your prices higher or less? And they just have a quick list of questions that they get through. And then this gets released within a week or two of the end of the month. And so you can see really quickly how well these companies are experiencing demand and growth. And so the gold line there are services companies. So these are companies that, think consulting companies, accounting, a hair salon, things where you have a person attached. And anything above 50 means that those companies are increasing. They're seeing more growth. So when you look at that gold line over the last couple of years, it's been solidly above 50. That means that services companies in aggregate have been growing. That blue line, though, is manufacturing companies. So these are companies that make a thing. And you can see from 2022 on, they were bouncing around below that 50 level, which meant that activity was declining. And when I talk with like owners of these small manufacturing companies, it's been pretty consistent over the last couple of years. And they're like, yes, it's been a really tough environment. That changed though, starting about 6 months ago, where you started to see that really hook up and activity was starting to accelerate. Notably, I would point out that this has happened despite tariffs being introduced, and it's been echoed outside the US, which is really interesting. So if we take a closer look to that, we will see that in different regions, we have also seen a reacceleration of manufacturing activity around the world. So up top, that green line is India. India is the one area where you've seen it decelerating, but it was coming off of the highest level that we had essentially ever seen in there. I will also note that India is one of the largest importers of oil. So as you think about the impact of that higher oil prices and having to absorb all of that, that has been a big drain on manufacturing activity. But if you look at the other ones, US, Eurozone, Australia, all of those have shown a really nice reacceleration. So this is meaningful because it gives us more confidence that the signal that we're getting from the previous survey is real, right? This is a broad-based manufacturing expansion. Let's dig for a moment into the labor market, though. When I talk with individuals, I have the great pleasure of talking with people all over the country from a lot of different walks of life. And one of the most common areas where I get questioned is about the labor market. And often it's parents who are worried about their kids, right? Like maybe they're heading off to college, maybe they're graduating and looking for their first job. And people are worried about this advent of AI and how AI is going to impact jobs. And I could totally relate. I have three kids. My oldest is starting in college next year, and my husband and I have had a lot of conversations like what should he be studying to help prepare himself for this kind of like new post AI world. And I have thoughts on this. So if you guys are interested in sort of like digging in deeper, please just like put that in the Q&A because I think it's worthy of discussion. But as we think about the economy and the market, so again, we have a very long history here of looking at the unemployment rate. This is the number of people who are actively looking for jobs relative to everyone who's in the labor force. What you can see here at 4.2%, which is the most recent number that we have, it is close to the lowest that we have had in like 60 years almost. I mean, it's kind of crazy. And so even though the number of people looking for work has increased relative to a couple of years ago, over any longer time period, the labor market looks really, really healthy. That red line there is the average unemployment rate once we take out recessions. So only looking at when the economy is expanding, even relative to that measure, we look really good. Now, what we've seen is that if we dig in a little bit deeper, if we look at where jobs are showing up, I think here's where we start to see the impact of AI. And again, this is still early, it's still tentative, but you'll see the total number of new payrolls or new jobs relative to last year that were created. That's that gold bar, which is about 500,000. The blue bars up top are industries that have seen the largest growth in number of jobs. Now, if you look at education and health services, leisure and hospitality, construction, these are areas that are very insulated from AI. So think about like the people who need to go and actually frame a house. You can't outsource that to AI. The people who are at the check-in desk when you go to a hotel, those are people, right? You have to have a person there to greet you. I don't know, Todd, maybe someday we'll have a robot who's AI driven, but I think we're a long way from that. For now, at least, these jobs are very protected from AI. Now, if you look at the bottom, those ones in the red are areas that have lost jobs relative to last year. You see government way down. That's sort of interesting. Um, but things like financial services, information technology, those are very definitely areas that are more impacted by the advent of AI. So think like computer science engineers. That's the sort of like classic area where AI can do the work of multiple engineers. And that's where we're seeing job losses. So I say all of this, but remember that overall, we saw really strong job growth, right? So this is where we can see an impact from AI and it'll hit certain areas, but we see growth in other areas that more than make up for it. All right, let's touch on the housing market for a moment. Homes tend to be, for most Americans, homes are their largest investment. So the direction of travel, so whether home prices are increasing or decreasing, has a really big impact on how people feel about their wealth and on their actual wealth. And housing's been a tough story over the last couple of years. So on the left, we have mortgage rates over time. And you can see, like, starting from about the 1980s, can you imagine you had to pay an 18% mortgage rate in 1981 if you wanted to buy a home then? I mean, think about how punitive that is. And then compare that with about 2% mortgage rate that people were paying in 1920 in 2021 during the sort of like depths of COVID. So for much of that time period, right, for call it 40 years, we saw mortgage rates just going down, 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 down. Now, over the last couple of years, we've seen a significant hookup where mortgage rates went from 2% at the bottom up to 7% in early 2025. In fact, they even peaked at 8% earlier than that. So if you look on the right, we've just sort of zoomed into the very recent past where mortgage rates have gone from that 7% rate all the way down to 6% and then back up again. So this is, I mentioned earlier, where our kind of like overall assessment of housing went a little bit more into the red, largely because of this. What you find is that when mortgage rates start to tick up, a lot of people just sort of step back. They're like, you know what? I'm not going to buy a home right now. I'm going to wait. And so this has been a big drag. And we hear from home builders that there are fewer people who are looking for homes. They've slowed the number of homes that they're building. And so this is an area where the market is very sensitive to what the interest rate is. But let's talk also about oil, because this is another area that very directly hits people's pocketbooks. Um, and it's funny because I spent much of my career in New York City and I didn't own a car. So I would take the subway everywhere or walk. And then I moved to Texas about 8 years ago, and suddenly I had to buy a car. I had to drive it every day, and it was a whole new experience. And I got an appreciation for how impactful that gas price is, right? Whenever you drive by and you have to refill that tank. And that's the reality for most Americans is that the price of this oil impacts not just, how much it costs to commute to work every day, but also has these like bleed through impacts in how much you're paying for your utilities, how much you're paying for, maybe a delivery order from a local restaurant. These are all ways that oil starts to impact really everyday prices. So on the left, you can see Brent crude oil. And you can see a lot of volatility there, but it had been hanging around like fairly stable for the last couple of years. And on the right, we zoom in to our experience over the last year and a half. So you can see, the oil prices bounced around between like 80 and $60. And they actually started to increase before the conflict in Iran broke out. So a market started to sense that there was potentially something afoot. So oil prices started to come up and then really spiked. Then they came down. And I like sharing this because it's a good instance of where, when oil got back to $70 a barrel a couple of weeks ago, peace was not assured, right? It was a very tenuous peace, but the markets were willing to price that in and start to accept a lower oil price on the expectation that things were moving in the right direction. They didn't have to be perfect to get back down to those levels. And then you can see more recently getting back up to that like $100 level because conflict seems to be rising again. So this remains a risk. And I think at $100, this is a very uncomfortable level, not just for US, but even more so for a lot of countries outside of the US. But this higher oil price will act as a drag on economic activity. If we get back to $70, $80, which I think is very possible, but it's not assured, then it sort of recedes from the background and no longer acts like a brake on the economy. The good news is that when we look at what consumers are actually doing, that actually tells a pretty good story. Another topic that's like showed up in the headlines more recently is this idea of consumer confidence. So when you ask people how they feel about the economy, and I'm curious how you guys feel, when you ask people how they feel in aggregate, they're going to say pretty terrible. And in fact, some of the measures of consumer confidence suggest that we're at the lowest levels of confidence that we've seen in the history of those surveys. Um, and again, I think there are a lot of different reasons for that. But what's interesting is that when we look at what consumers are actually doing, so are they spending money? The answer is yes, they are. So this is looking at the growth in retail sales. You'll see up top, it says real retail sales. What that means is that we take out the impact of inflation. So for instance, rather than looking at how much you're spending on eggs, we're looking at how many cartons of eggs you're buying, right? Because we want to take out that noise from the price of eggs going up and down. What you see is that in 2023, consumers were pulling back on spending. That was also when inflation was really high, so it makes sense, right? People were buying fewer cartons of eggs because they were a lot more expensive. But what you see is a steady improvement from there, such that we are well into positive territory. So that gives me some hope. When we look at the labor data, it's quite strong. When we look at how people are spending their paychecks, it looks like they feel very comfortable continuing to spend, and companies are continuing to hire. So that all tells us, yes, there are risks out there, but the overall health of the economy is actually quite strong. So, what's going on in the market? Because the market is not always just what's happening in all these economic indicators. And in fact, a lot of the economic indicators we just looked at don't capture the reason for the market being so strong. And we have this fun cartoon here. I don't know, after a while, all these all-time highs start to look alike. Right. We've gotten used to this idea that these companies and stocks just keep getting higher and higher and higher. But it's worth pausing a moment to understand why these stocks have continued to go higher. Because it's not really because the labor market's stable, and it's not necessarily just because retail spending is increasing. Why is it? It's because of AI, right? So the excitement and the exuberance around artificial intelligence has so overwhelmed any other potential concern about the economy that it's just driven the markets to ever newer highs. So, I'm sure you've heard the term Magnificent Seven. I won't quiz you about who's in the Magnificent Seven. You can look at the key down on the bottom: NVIDIA, Meta, Tesla, Amazon, Google, Microsoft, Apple. These are all household names now, right? We've been hearing about them for years. And you can see the total return for each of them for the previous 3 years. And look at 2023 in particular. I mean, NVIDIA was up over 200% in that time period. Just absolutely remarkable. And these names were not just performing extremely well, but they were also really large, which meant that when we look at the overall S&P, they had this huge impact. Over the course of those 3 years, they provided about half of the full market's return. Just 7 names provided about half of the market's returns during that time period. But you do see that the overall returns have come down, right? They're still great. This is not, I don't want to rain on anybody's parade. They're still very, very strong. But not only have they started to slow a bit, so far this year, they've actually started to go in different ways. So we're seeing more dispersion between what's happening in each of these names. So you see Google up so far this year, 14%. NVIDIA is actually not the leader. Again, not to say NVIDIA is not a great company, but the way it's been performing is looking a little bit different. And then look at Meta and Microsoft actually down quite significantly so far this year. So what is it that's happening? And I alluded to this earlier when we were looking at the overall market returns. I think what we're seeing is the next leg of this AI trade, right? So it's no longer just the darlings. The Mag 7 are the ones who are sort of at the forefront of building these models and enabling them. So who's next? Here we see that dark line in the middle is the S&P 500. So this is the broad large cap market. The -2% is Mag 7 overall. So what is it? These 7 names that were the darlings of the market have actually underperformed so far this year. And then up top, that gold line is semiconductors, minus NVIDIA. So NVIDIA is a semiconductor, but for a long time, they were the only company who could build the chips that were needed to run these AI models. That's why they had this huge competitive moat. They were the only ones who could do it. But guess what? Some of these other semiconductor companies have been figuring out how to be competitive. They too make chips, and they're becoming more important in the build out of this AI. Those names alone in aggregate, semiconductors minus NVIDIA, have doubled so far this year. So they've just been on an incredible tear. Now, over the last week or two, they've had a bit of a chink in the armor. So a good reminder that these don't go all up all every day. But you see that note there, semiconductors now make up nearly 20% of the S&P 500. So another area where these have been going, which I think is worth spending a moment on, is thinking about CapEx in general. So these are, I mean, just the numbers are mind-boggling. Um, the hyperscalers are expected to spend nearly $1 trillion on capital expenditures in the near future. That means it's like all that money that they need to build the data center, to get the servers, to plug in the power, to get the chips, like all this stuff. All that money needs to be spent by Meta and Google and Tesla, and that money has to go elsewhere. So you can see here, we're looking at the Magnificent Seven, the amount of money that they're spending in CapEx relative to the CapEx that's being spent for the rest of the market. And remember, like CapEx in general is like money that's spent in equipment that's expected to help grow your business in the future. So, Capital One spends money on CapEx, or United Health spends money on CapEx, but they'll be doing it potentially for different reasons. But what you see here is that the CapEx spent by these Mag 7 names is increasing as a proportion of the overall S&P 500. Today, those 7 names are spending about half of the CapEx dollars that the whole market is spending. Now, they've been able to do that because their earnings were also growing. So that's that gold line. So as they were spending more money, their earnings were also increasing along with it. The last couple of years, that has started to diverge a little bit, where their spending is outpacing their earnings. And more recently, you've heard the market start to do some hand-wringing about this. Oh, $1 trillion? That sounds like a lot. Are they going to get a return on that? Right. So the market is starting to become a little bit more discerning about who's spending money and where. And I think that's another reason for this, next leg of the AI trade, where maybe you don't want to own, or maybe you don't want to like be so invested in those names that are spending the $1 trillion. You want to be invested in those companies that are receiving some of those $1 trillion. It's worth noting also, when we look at the amount of CapEx being spent relative to the size of the economy, I mean, it's really extraordinary. So this is looking at how much money is being spent on computers relative to the size of the whole economy. So if you look at 2000, we were over 1% of the economy was being spent in computers. Now look at the most recent. We're above that peak. And in fact, if we get to that $1 trillion, it's going to be even higher. So there's a lot in the economy that's riding on these dollars that are being spent. Now, I would argue that AI is probably a bigger technological revolution than like the dot-com or the telecom that was prevalent in 2000. And happy to talk about that some more if you guys are curious. But it does mean that we have a lot, as a broad economy, we have a lot pinning on whether or not AI is really successful. The good news is that companies continue to earn, and it's not just the Mag 7, and this is really important. So here we look at the growth in earnings among companies of different sizes. So the dark blue bars are the S&P 500. That's the index that we've been looking at. These are the largest names. The gold is mid-sized companies. The light blue is small companies, all public companies. But those dark blue lines, you can see in the first quarter of 2026, put up 30% growth in earnings, just extraordinary. And it's amazing in that they really hang in. They continue to have extraordinary earnings growth for the remainder of the year. Then look at that gold line. That's mid-cap names. Now they're trailing, they're running at about 12% for the first quarter, but when you look further out, they start to increase. And in fact, in some cases, potentially by the fourth quarter of this year, surpass large cap earnings. The blue bars, it's the same thing. So what that tells you is that the earnings growth that we can find in the market is no longer just those handful of names. It's starting to sort of diffuse out into other parts of the market. Now, as an investor, that's a great thing, right? Because there are other opportunities for stocks to expand as their earnings improve. Let me just spend a moment on bonds, and then we'll wrap up. And then Todd, I'll send it back to you for any questions. Bonds are a really important part of your portfolio. Stocks are going to give you the growth. Bonds give you the cushion, right? Because we were talking earlier about the yield curve, right? You get paid to lend money and you get that on a regular basis. So we think it's really important to have that as that cushion over time to help smooth out the returns in your portfolio. And there are a couple of ways to read this chart that we're looking at here. So this is looking at spreads. The dark line is high yield. So these are companies that are maybe newer, less diversified, a little bit more risky. The gold ones are investment grade. So think your Apples and IBMs of the world. These are very established companies who, have long track records. The market's not terribly worried about them paying money back. But if you're worried about a company paying you back, you're going to demand more, right? You're going to want a higher yield. So in general, what we see are that high yield issues, are still demanding a higher yield, but they've come down. So when those spreads compress, that means that the market is not worried about whether or not these companies are going to pay back their loans. And so this tells us that the market is like, yeah, things are pretty good. But it also tells us that you're not getting paid as much as you might have in previous years to own these names. So something to be aware of. If things kind of start to get a little bit more dodgy, you'll start to see these spreads kind of widen out a little bit. The good news is that as a bond investor overall, you're getting paid much, much more than you were, say, in like 2021 in the depths of COVID when interest rates were really low. So you're actually getting paid to take some risk today. I will wrap up on another one of my favorite charts. We call it Stocks for the Long Run. This was put together by Professor Jeremy Siegel, who is a legend in this business. I've met him a bunch of times, and he just, I think he's 83 years old and continues to be just this like incredible mind. But he initially made a name for himself back in the 1980s because he went back almost 200 years and collected information about each of these different asset classes. So he managed to get, stock prices from 1815, right, and build that annual series over time. He was also able to get inflation data for that. So what he does, similar to the exercise that we did looking at retail sales, what he was able to do is take stock prices from all these different time periods and then take out the impact of inflation. So why is that important? If you think about how you grow wealth, you need to grow wealth so that you have more purchasing power. You can buy more things. If you grow, let's say your stock portfolio, but everything's more expensive, you haven't really grown your wealth. So importantly, this takes out the impact of inflation so that we can compare how much wealthier did someone get in a high inflation period versus how much wealthier did they get in a low inflationary period. What you see there is up top stocks, just up and to the right, fairly consistent. Now, on any given day or any given year, even, stocks are going to bounce around a lot. You have like a little bit better than a 50% chance of increasing your money on any given day in the stock market. That's not really great odds. But over a 1 year period, 10-year period, your chances of success, your chances of growing your wealth go astronomical. Over a 10-year period, you have about a 98% success rate of being able to grow your wealth. So what that means is that if you have a longer time period to invest your money, stocks have had a remarkably consistent track record of growing wealth over time. And in fact, Professor Siegel, when he first put these numbers together in the 1980s, that long-term average annual growth rate was about, I think, 6.6%. Today, 40 years later, the average annual growth rate after inflation is about 6.6%. So that slope has been very consistent. So as you guys think about how do you reliably grow wealth over time, stocks have done a really amazing job. Second, there you'll see bonds, right? And that's the cushion for your portfolio. So you don't get the same gas that you do with stocks, but you still get a really reliable income stream. And together, those two are a great formula for being able to grow your pocket of wealth over time. So with that, let me pause and turn it over to Todd and see if we have any questions.
Thanks, Kara. That was great. I think we have a very shy list of attendees here because I do not see any questions that came in, but I do not believe that nobody here has any questions. So if you think of any in the next couple minutes, type them in. Otherwise, I did jot down a couple that I have for you, Kara.
Yeah, let's
Um,
go.
and I kind of wanted to stick with ones that I hear often from clients, areas of concern and things that impact them. And maybe some of them aren't necessarily questions, but things that you can maybe elaborate on or talk a little bit more. I'm going to start with inflation. You talked about the market at the beginning of the year was pricing in a couple interest rate cuts, and now the market's pricing in an interest rate increase. Um, I think that kind of some context around why, but it looks like inflation is higher than the Fed wants it to be, and the labor market's stable. So towards the beginning of the year, it was like inflation was being tamed and the labor market was maybe looking a little bit less stable. But can you maybe speak to why the market's pricing in a rate increase this year?
Yeah, and this is really comes down to oil. If oil were still at, anywhere between 60 and 80 bucks, we wouldn't be having this conversation at all. There would have been more room to cut at least once or twice. We were skeptics that the Fed was going to be able to cut twice, simply because of what you suggested, which is that the economy was actually really healthy in the beginning of the year. And usually the Fed cuts interest rates to provide some stimulation to the economy. And the economy was doing fine on its own. So I think as long as we see oil high, especially around $100, the Fed's just not going to have room to be able to cut rates. And so I think that's going to be the really key measure to keep an eye on.
Okay. Um, and I think that that kind of goes in. We did get a couple questions that came in. So one of them, what are the key risks if escalation continues in the Middle East and oil prices continue to rise?
This is one of the big risks that we face. And it's interesting, like for what it's worth, I'll just share, before I started on Wall Street, I've been in this business 26 years, but before that, I was actually an international political risk analyst. So I find this stuff like really, really interesting. But I find it interesting, but over the course of my 26-year career, like most of the time it doesn't matter because the market is able to look through conflict outside the US remarkably quickly. So, and you saw this in spades in March, right? So, sorry, March, right? Yeah. So as soon as the conflict started, right, like markets came down. But then over time, even though a peace deal wasn't really on the table, the market started to rebound again, right? So we started to focus on AI earnings and other things, and the market was willing to kind of look through it. We saw that same with Russia invasion of Ukraine, right? Where the market really took a dive and then slowly started to come back again. Oil is the way, though, that conflict overseas transmits to US shores the most clearly. And so that is the risk. If this lingers, and oil stays at $100, it essentially acts like a drag on economic growth. Um, the good news is that the US economy in general is much more insulated from high oil prices relative to many other economies. And this is a key difference between now and like the 70s and 80s. So today we actually export more oil than we import. We're still very, very tied to like the global oil markets. But what that means is that as oil prices go up, we have oil companies that benefit and that feeds back into the US economy. So in very particular terms, I think what happens if oil stays if we have conflict continuing, we have oil staying higher, lower end consumers in the US in particular get quite hard hit by that. And then we start to see some big oil importing countries that really get hit by that as well. So overall, it just becomes a dampener on economic growth.
But doesn't necessarily mean that there won't continue to be economic growth, but maybe just slower economic growth.
Yeah, and again, like we've seen in the first half of this year, we've had really strong economic growth, and that's because of AI. And we saw the same thing last year. Like, remember how tariffs were this huge drag on the economy, but everything else is okay, right? So it's always this
Yeah,
balancing act.
yeah. Um, One point I wanted to make on inflation, and I think you covered it in your chart on inflation, but when you were talking about when inflation comes down, that doesn't necessarily mean that the prices are coming down. It means that they are increasing less rapidly than before. And I think that's a common misconception is that people are like, oh, inflation is lower, my grocery bill is still high.
Yes,
So I think
yes,
that's an
and that
important one
is
to keep in mind.
that is such a source of angst with people, and I see it misrepresented in the media all the time. Unfortunately, there is not this moment where you're going to go to the grocery store and things are going to be lower, right?
Yeah.
They're like eggs have come down in price, whatnot, but in aggregate, those prices will continue increasing. It's just, as you said, not as rapidly as before.
Yeah, yeah, exactly. Um, I've got a couple more here. So I think that this one ties into another question that I wrote down. So I'm going to ask mine first, and then we'll jump into one of the attendees' questions on AI. And you had talked about the dot-com bubble and this potentially being more, productive for the economy than maybe that dot-com boom was back in the early 2000s. But that word bubble from 2001 and from 2008 has been a
Yeah.
common theme that we hear with clients on, there's massive amounts of spending being pumped into AI infrastructure. But is it a bubble? And I think that last year, from some of the things that I read, there were several companies that were able to actually pinpoint that some of those investments were starting to pay off. We've invested huge amounts of money into AI infrastructure. We can actually now target our earnings per share has increased, our productivity has increased. What are your thoughts on that?
So the fact that we're asking this question is a good thing, right? The more awareness and sort of consternation that we have a bubble means that we're more prepared for what's to come. So that's always good. What's really unique about this AI revolution, let's call it, is that it's happening so rapidly, right? So these, as I mentioned, like on pace to spend $1 trillion. These dollars have to be spent really quickly in order to capture the market opportunity. And as you suggested, the payoff for that opportunity takes longer to show. So when we look at, for instance, like revenues at OpenAI, which runs ChatGPT, and Anthropic, which runs Claude, we see their revenues are spiking right now, right? So suddenly they're starting to charge more for some of their models. They're figuring out how to monetize all of this, and their revenues are increasing significantly. Their revenues are still way lower than their expenses, right? So we haven't hit that point yet, right, where they're actually profitable. But every company has some version of this, right? They're spending money on AI, but it's not really clear what the payoff is. So I think this will take time. And I think ultimately the sort of productivity benefit of AI will be absolutely massive, like on the order of something like electricity. And the one thing that I like to share with people is that, if you go back to some of these other technological revolutions, and I think electricity is a great example. If you look at Edison Electric, that was the company that was actually responsible for plugging in, all these homes and factories to the grid so that they could get electrified. That stock did really, really well initially. But today, the S&P 500 is not made up of electrical companies. Today, the S&P is made up of companies that use electricity. And that's ultimately where I think the true benefit will be. And you brought up this idea of bubble. Um, as long as you have all of these other companies that are actually benefiting and seeing productive uses of AI, we looked at earnings for small cap and mid cap company. That's where you mitigate that impact of maybe spending too much money in the initial build out. And if you don't mind, I see another question that sort of like asks about like defensive moves in the market. And I think that that's part of this story too. So if you don't mind me addressing that one as well.
Yeah, go ahead.
The good news is that there are a lot of other areas where you can be protected if we find out that AI has been overbuilt. So let me give you an example. I mentioned I've been in this business 26 years. That means that I started almost to the day that the NASDAQ peaked in 2000. I spent my first few weeks looking at my monitor and being like, is it always red? Like, but I don't understand. So, but if you look at the NASDAQ from the day that I started in the business, the NASDAQ took 16 years to get back to that previous hike, right? It went massively down and it took forever to get back to where it was. If you look at value, which is just like another area of the market, it took, I think, like 2 years to get back to its peak from that time period. And that's like, as an equity investor, that's a very reasonable time period to wait. And if you look at other housing market, same thing. So in 2008, it took, I want to say 14 years for some of those names for financials to get back to their peak. But growth took a couple of years. So it's just a good reminder that all you have to do is make sure that you have a diversified portfolio. And I know this is not like exciting or like sexy, right? Everybody wants like ooh, what's the next NVIDIA? Own a diversified portfolio, and that is what will protect you if there are some of these names that are being overvalued today.
Yeah, and I think that that's a great reminder. I see two questions that kind of tie into each other about how our investment strategies here at Well Traveled Wealth align with some of the stuff that you've been saying, Kara. And it's exactly that. And to the other point about defensive moves in the market, it's about owning a well-diversified portfolio with a thoughtful strategy that adjusts over time and keeps up with these changes. And us here at Well Traveled Wealth, we do leverage people like Kara and her team and other teams at other institutions to talk through this kind of data and then make thoughtful changes to our portfolios over time. Another question here on the last chart, does dollar equal cash? So then is it best to keep my cash as low as I will need for the period? Yeah, I think everybody's cash needs are going to be different based on, job stability in retirement, not in retirement, and, what foreseeable emergencies or large expenses might be coming up. So that's definitely something that's more of a case-by-case situation. And we can certainly talk you through that during our next review. And then, do us small-time investors have to worry about the perception of financial policy and those who make it being so manipulated by political ideology?
Yeah, so here you're tugging at my sweet spot with the political and the financial together. And this in my mind is so important because it feels like today everything has been politicized. I mentioned earlier, like consumer confidence surveys, and it's very interesting because if you break down those consumer confidence numbers between Democrat and Republican, you'll get almost opposite stories. So, for instance, when Trump was first elected, what you saw, like right before the election, you saw Democrats who were saying that they felt quite confident about the economy. Republicans did not feel confident at all. And then immediately you have this election and they switch places. Right. Overnight, Republicans are like, I feel good.
Yeah.
And Republicans are like, I feel terrible. But I like to use that example because it shows how nothing in reality actually changed. And Trump was coming in, like, big surprise. Even Trump didn't expect to get elected. So it wasn't like he had this playbook that was like all ready to go. But we see our person in the White House and we immediately feel better. And so I think that's also a reason to sort of like discount sometimes how we feel about things. We just looked at the numbers and the economy actually looks really good. So the other piece to this is the Federal Reserve, right? So I mentioned don't fight the Fed. The Fed's very, very important. Part of the Fed's strength is its independence. And I think what we've seen is that the administration has been much more engaged in trying to get the Fed to a particular outcome than what we've seen in recent past. Now, I will caveat that in that we have had both Democratic and Republican presidents and Congress people who have tried to influence the Fed. Usually they want rates to go down. So the current administration is not unique. It's just been a little bit more vocal than some other ways of trying to impress upon the Fed. But the Fed knows that their power is in independence. So they're heavily motivated to demonstrate that they're going to go their own way and do the right thing relative to the economy. And I think Kevin Warsh, in like his short time, he's the new chair of the Federal Reserve. In his short time in this new role, I think has really tried to demonstrate to the market that he's going to go his own way, and that's a good thing.
Um, I don't see any other questions on here. I think we've answered them all at this point. If anybody thinks of other questions after the fact, feel free to shoot me an email. I'm happy to get you an answer from myself or connect with Kara and get you an answer there. But Kara, I want to thank you so much for taking the time to talk with us today.
You.
Hopefully, everybody has found this somewhat beneficial and leaving a little bit less overwhelmed. I think the political headline ending on that one is a good note because it is so polarizing, right? You flip on the TV and it is
Yeah.
instantly one party versus the other party. And as it relates to the market, I think it's more important to keep in mind the data that Kara shared, and the data is what matters, not the headlines.
Yes. Love that. Love that. Thank you so much, Todd. Always great to spend some time with you. And thank you, everybody, for engaging.